Good evening and welcome to the Money Show. I'm Kavita Thaplial and this is the show that puts your money matters front and center in a world full of financial noise. We are here to bring you clarity, confidence and control over your personal finances, whether you are planning for retirement, building a portfolio, navigating debt or just trying to make smarter money decisions. This is your space, your guide and your weekly check-in with your wallet. Every evening we bring you insights from top financial experts, decode the latest trends and answer your burning questions on saving, investing, spending and everything in between, because you're on the Money Show. We believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice, and which is why we are over here helping you. And let's begin the show today with a very important and a special initiative. That's right, the beginning of the month often marks a key financial activity. The salary credits, bill payments, planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. Now, to encourage this habit, SBI Mutual Fund in collaboration with Times Network is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. Now, as a part of the campaign, we are observing 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP or ensure your existing SIP continues. So go on and set your reminder to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. So every time we talk about a special initiative, we also focus on a very special topic. And today, the topic or the category that we are talking about, which is in trend these days, it's Income Plus Arbitrage category. Let's dive deeper into this. Let's understand its benefits and the relevance for your portfolio. I'm joined by Aditya Gangal, Zonal Head, Mumbai and Goa SBI Mutual Fund. Aditya, hi. Welcome to the show. And let's talk about this very talked about category, Income Plus Arbitrage. So the name, it really sounds slightly complicated, but then, if we want to just understand in easy language, what kind of investment are we talking about? What kind of category are we talking about? Are we talking about equity or hybrid? What kind of fund exposure and what are the benefits of this category?
Good evening, Kavita, and thank you for inviting me for this show. I'm proud to be associated with such a noble cause. So today what we are discussing about is Income Plus Arbitrage. And this category, if we talk about, is interesting, at the same time, very upcoming category. So this category basically is a fund of fund structure, where whatever allocation we collect into this fund, this single scheme, is invested into actively managed debt funds and arbitrage. So the asset allocation typically is 0 to 50%, 0 to 50% can be invested into, 35 to 50% can be invested into arbitrage fund, and 50 to 65% is invested into actively managed debt fund. Now, why I said it is interesting is because it is one fund with multiple benefits. You have a professional management, you have simplicity, you have automatic asset allocation and tax efficiency. And when I say upcoming, Kavita, what you mentioned, this category, as I said, is recently launched. There are some 15, 18 odd funds in this category. And the category, out of this, 8 to 10 funds are almost launched somewhere around March, April. So last 8 months, the category has already collected somewhere close to around 22,000 crores. Typically, the benchmark in this category is 65% will be Nifty Composite Bond Index and 35% will be Nifty 50 Arbitrage Index. And because of various efficiencies in terms of taxation, stability of returns, this category is gaining a lot of significance and prominence and a lot of interest among not only normal investors, but also evolved individuals and HNIs, ultra HNIs and corporate investors.
All right. So, Aditya, I just want to understand now, what is the purpose that this particular category, tries to develop in your portfolio? What should be the reason to have this category or this kind of a fund in your portfolio? What are we trying to achieve? Are we too risk averse? And so we should be opting for this category. Are we looking at accumulating liquid fund or just parking money for certain duration? What's the actual purpose? Why should investor consider this category in their portfolio despite having diversification across equity and fixed income?
Absolutely. Very interesting and good question, Kavita. So typically the objective of this category is to give debt-like stability with a better tax efficiency, as I rightly said. In the recent finance bill, the fund of fund, the taxation which has enabled fund of funds to have equity-like taxation if somebody is staying invested in this category for more than 24 months. That actually has ensured that there is a rising interest in this category. Before that, the fund of funds were typically taxed as per marginal tax rate. And all of us know post 2023 indexation, which was one of the key features of investing into debt mutual funds, they had gone away with. So people who follow the asset allocation, how much into equity, how much into debt, there was a big hollow because traditional investment options like say fixed deposit or maybe normal debt funds no longer became tax efficient. So post this finance bill, which enabled fund of fund category to have a taxation if the minimum exposure to equity is 35% and the holding period is more than 2 years, the investor post 2 years, if whenever they put a redemption, they will be taxed. There will be a capital gain of 12.5%. So that itself is the biggest USP of this fund. And to your question of why not allocate money directly to say debt funds or an arbitrage fund, I mean typically in income plus arbitrage category, as I said, it is a mix of debt oriented schemes and arbitrage scheme. Unlike allocating money into only debt funds or arbitrage fund, the exposure is to a single scheme and the investor has to take a fund selection call. Here you have an exposure to multiple schemes. The fund manager takes a call on your behalf. And whenever a fund manager is deciding to switch from one scheme to another based on interest rate outlook, there is no tax incident which comes to the investor. Unlike in a traditional investing, if somebody is switching from one scheme to another, it attracts taxation. So there are a lot of benefits of this category. And as I said, again, I reiterate, post the finance bill and the relaxation of taxation, which the fund of fund as a category the government has notified, I believe this category will only grow. The AUM, as I said, somewhere around April of this category was somewhere around 3,000 odd crores. But today, as we speak, is in excess of 20 to 23,000 crores. It means last 8-9 months, incrementally close to 20,000 crores has already come into this category because of the benefits that it provides to the investors in terms of post-tax returns.
All right. I just want to understand the arbitrage aspect of this particular category. How, because arbitrage, in terms of considering the kind of risk that you might not want to take, how does it work in benefit for the investor?
So arbitrage, Kavita, as a category, as I said, again, I will take you back to 2023, where arbitrage were very limitedly and scarcely used. At that time, the industry AUM of arbitrage was somewhere close to around 80,000 crores. And because the indexation benefit in debt mutual fund investing was taken away, a lot of money and a lot of flow started coming into this category. Today, as we speak, this category is in excess of close to around 2 lakh crores. Now, arbitrage, unlike normal equity funds, is a pure hedged strategy where you buy in cash and sell to the exact decimal in future. There is no exposure. There is no open exposure which is there in the fund in terms of equity. So that is how it is a completely hedged exposure. So what happens is if the exposure is hedged and it happens from every cycle, every monthly rollover to rollover, the fund manager churns the portfolio and rolls it over to the next expiry cycle. So whatever are the spreads which are there at that point in time, that the fund manager is able to lock in those spreads. So irrespective of market movement, wherever, markets may go up, may go down, unless and until there is any significant volatility in terms of inflows or outflow, the returns profile of arbitrage as a category is very stable. So that itself gels along well with the purpose where you have income or a debt which gives you a stable income. Also arbitrage. So the combination of debt plus arbitrage, which is there in this income plus arbitrage fund, is something which can be suited for low to medium moderate risk profile type of investors who are seeking, who are looking at 2 to 3 years type of their investment goal and want a regular income, capital appreciation with less volatility of pure equity funds.
Aditya, what happens is a lot of time people forget the right objective of a particular fund or a category in their portfolio. Now, how do I avoid over diversification? Can there be a case of over diversification if you have this category in the portfolio? What should you actually stay away from if you have something like an income plus arbitrage?
So I will not say over diversification, because at the start when we discussed about typically how this category works. So if we see the major combination of this fund is somewhere close to around 60 to 65% will be into actively managed debt funds. Now we all know debt investing is a tricky investing because there are multiple scenarios. There is a rising interest rate scenario, there is a stable interest rate scenario, there is also a falling interest rate scenario. Incidentally, we have a policy tomorrow, RBI policy. So typically, there are various category of funds which do well in these three scenarios. So depending on which interest rate scenario we are or which rate cycle we are currently, the fund manager, based on his expertise, will auto allocate to these different strategies. So for instance, when we started off, we had an exposure to gilt fund. But then when we saw a rate cut, which happened last to last policy, where RBI did a rate cut of almost 50 basis point. After that, our view on the long-term yield, the long-term yield curve changed. So we shifted allocation into the shorter end of the curve, and today we have allocation to the likes of corporate bond and all. So fund manager, based on the various rate cycles, will keep on taking this call. Diversification through a single fund also helps because it further mitigates down the risk rather than taking a direct exposure to these schemes at an individual level.
All right, I think with that, it's a wrap. Thank you so much, Aditya, for taking time out and helping us understand the importance and the right relevance of this category, Income Plus Arbitrage. Thank you so much for talking to us today. And with that, guys, it's time for a short break. But on the Money Show, we'll be answering your portfolio queries after this break. So all you have to do is just send across your queries, just in case you haven't yet. We do your life financial planning on the show. We answer your mutual fund queries, your insurance queries, anything about any kind of loan that you might to plan for or strategize and align your investment strategies with your financial goals. We are there to help you. Our experts, so all you have to do is just send across your queries on the WhatsApp number, email ID that's flashing on the screen, and see you after this break.